What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today we're going to discuss how passive losses work for limited partners or LPs in real estate syndications. So a real estate syndication, for anyone that doesn't know, it's a partnership where investors come together, they pool their funds to invest in real estate deals that would either be too large or complex for most individual investors to undertake by themselves. It's a form of group investment where you have a sponsor or GP, general partner, that manages the project while the other investors, limited partners or passive investors, provide most of the capital. So I often get asked the question, if I invest in a real estate syndication, is there any tax benefit to me? Can I use my passive losses from the investment to offset other income? And usually this is coming from a high net worth individual. Quite often they have a high paying W-2 job, or they're running a business that produces a lot of income for them. So typically, unless they're involved in a real estate trader business, they're not going to be able to use those losses because they're not going to be able to qualify as a real estate professional. If you're not a real estate professional, your losses are going to be considered passive and suspended or carried forward unless you have other passive income to offset the losses. So remember, all of your activities in the eyes of the IRS are either passive or non-passive. Passive activities are rental properties, so rentals are passive by default, or other businesses that you don't materially participate in. Now, generally, when you invest in a real estate syndication, they're going to do things like run a cost seg study, use accelerated depreciation, and push out sizable losses in that first year. So if you're not able to utilize those losses, they're going to carry forward to future years. And if you receive any distributions or cash flow from the deal, you're going to take that tax free. So it's not like if you can't deduct your losses, it doesn't make it a bad deal. You just need to learn how to manage it because those losses at some point will become deductible. So the losses allocated to you are going to be suspended if you don't qualify as a real estate professional. And just as a reminder, I mentioned they're usually running cost segregation studies. So cost segregation study is simply a detailed engineering study of a building's components so they can identify and reallocate 5, 7, and 15-year assets, which have a shorter recovery period than the usual 27.5 years for residential, real estate, or 39 years for commercial. So that cost seg study identifies those assets. Those shorter-lived assets with lives of under 20 years are eligible for bonus depreciation as well. So by classifying those, you're really accelerating those deductions in the first year and other early years. The LP, as an LP, you're not materially participating in the deal. So even if generally you're not. So even if you do qualify as a real estate professional, remember you have to materially participate. But in the case when you're not qualifying as a real estate professional, you're not materially participating, your losses will be suspended until something happens or you make a decision to do something that will allow you to utilize those losses. So as a non-real estate professional, you can, one, liquidate the investment so you can free up the losses that way. Typically, most of your syndications run somewhere between 3 to 7 years. Now, each deal's got its own timeline, but typically they're going to cash out after sometime between 3 and 7 years. So the deal's liquidated, your losses at that time are released and can be used against any other income. Another option is to invest in other deals that generate passive income. So the passive losses can be used to offset passive income, meaning you're not paying tax on that passive income. That's the second method. Another is you can liquidate other deals that have gains. So I did this personally several years ago. I was invested in single family homes and started to transition into more syndicated deals. So when I would sell a single family property, I would take those proceeds and invest it in some type of syndication. I'd have a gain from the sale of one of my properties, but then the losses from the syndication would absorb that, or a significant portion of it. So that's another way. You liquidate other deals that are considered passive, and the gains are offset by the losses from your syndication. Now let's look at this from someone who does qualify as a real estate professional. So remember, to qualify as a real estate professional, you have to pass the 2 tests. More than 50% of your time spent in real property trades or businesses. More than 750 hours must be spent in real property trades or businesses. So those are your 2 tests. Once you qualify as a real estate professional, you must also materially participate in your rental activities in order to deduct the losses. So it's going to be difficult to materially participate in a syndication as an LP because there's special rules. So typically we have 7 tests to demonstrate material participation, 3 primarily used for real estate investors. So you have test 1, 500 hours of participation. Test 2, substantially all, you pretty much do everything. Or test 3, 100 hours and more than anyone else. Well, when it comes to LP investments, the only test you can use here is the 500 hours of participation. So you're going to need to show participation for 500 hours in your overall portfolio, because what you'll do, you're obviously as an LP, you're not going to be materially participating for 500 hours in the syndication. But if you have another real estate portfolio, your own portfolio of assets, you can use the grouping election to group your syndication investment with your own real estate portfolio. So now you only need to show the 500 hours in the aggregate to hit that material participation, and the grouping election allows you to use the losses from the syndication to offset your income. So when you're doing deals where you're an LP, you're trying to use this first test, the 500 hours of participation. Now, this may not be difficult if you're hitting real estate professional status by, say, managing your own rental portfolio, because you're already going to pass the 750 hour test. The real estate professional test of 750 hours, those hours have to be material participation hours. So you're already going to have that. So making the grouping election is going to allow you to utilize those losses. Now, if your 750 hours come from some other activity that doesn't involve your rentals, maybe you own a construction company or you're a real estate agent. In those cases, your 750 hours are coming from somewhere else. So you still need to show 500 material participation hours in your rental portfolio to qualify to group in your LP investments and utilize those losses. Now, you don't have to do the 500 hours on your own rental portfolio if you're not grouping the LP investment in. Maybe you typically use the 100 hours and more than anyone else. That's fine. You could use that for your own rental portfolio. But when you bring in your syndicated deals where you're an LP, you're going to have to get up to that 500 hours if you want to be able to deduct the losses from your LP investment. Now, regardless whether you qualify as a real estate professional or not, as a LP investor, you will receive a K1 each year reporting your share of the syndication income and losses. So make sure you understand how to read the K1 and how to report it correctly on your tax return, or work with an experienced tax professional so everything gets picked up correctly. K1s, sometimes they can be a little daunting. There's quite a bit of information in there. Often you're going to see a lot of footnotes. Make sure you read those carefully. That way you don't mess things up on your tax return. Generally best to work with a professional. But that about does it for today in our discussion on passive losses for limited partners. I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulicegroup.com/contact. That's THEPULICEGROUP.com/contact.